Here we have a simple trend, and sometimes in a trend a gap will appear. What is the significance of this gap? It is an explosion of speculative interest, either from the end of a day or an end of an hour chart, and the market opens the next thing much higher. Gaps in bull markets are support, and in bear markets a gap would be resistance. There is a tendency amongst markets to want to try and cover gaps, but it gives us great information. If the gap is attempted to be covered and fails, it's a very, very bull sign. Gaps tend to arise. There are three sorts of gaps, three familiar characteristics of gaps, which people should bear in mind. And very often they arise a gap is a completion gap, when very often a pattern will complete with a gap down, showing a massive spurt of bearishness due to the completion of the pattern. So that's the completion gap. This is what might be termed a fast-moving bear market called a continuation gap. And this will be the exhaustion gap. Now, what follows from this is these three tend to go together, and they're to do with an explosive move in the markets. The completion gap is the initial one, gap one. The second gap is the continuation gap, which is halfway, tends to be halfway in the overall move. That tends to be halfway, and the exhaustion gap is the last gap, the final gasp and blow off of the bearishness, and that is the end of the move. So gaps tend to come in threes. The continuation gap, the middle one, is in the middle of the move. This gives rise to another thing. The exhaustion gap is the market goes there and then opens up here. Then you have an island reversal with the gap right across the market, and this is a very bullish sign. Fascinating things, gaps.